In March 2009, a woman named Sandra from outside Cincinnati transferred $23,000 into a brokerage account. Her husband thought she was losing her mind. Her father told her she was going to lose everything. The news was calling it the worst financial crisis since the Great Depression. Unemployment was climbing past 8%, banks were failing, and Sandra was buying stocks. Not because she had a finance degree, not because she had a hotline to a fund manager, because she had noticed something. A pattern that had appeared before every major wealth shift of the past century. A pattern that almost nobody was talking about because in the middle of it, it feels indistinguishable from disaster. 4 years later, that $23,000 was worth just under $140,000. The question isn't whether Sandra was lucky. She wasn't. The question is what she saw that everyone else missed, and whether that same thing is forming right now. Let's start with the mechanism, because once you understand it, you can't unsee it. Crashes don't destroy wealth. They relocate it. This is the part that gets left out of every mainstream financial conversation. When markets fall 40 or 50%, the value of quality companies doesn't evaporate. Their earnings still exist. Their products still get sold. Their underlying worth is still there. What changes is who holds the shares. Panic sellers hand them off at distressed prices to the buyers who are ready. Then the recovery comes, prices normalize, and the gap between those two groups compounds for a decade. It's not random, it's a transfer. And it follows a pattern that's been documented across every major market cycle going back 100 years. In 1974, markets dropped nearly 50%. The people who bought during that drawdown saw returns that reshaped their financial lives over the following decade. In 1987, the market crashed 22% in a single day. Within 2 years, it had fully recovered. Within 5, it had doubled. In 2002, Amazon fell from $85 to $6 a share. Anyone who bought near that floor and held is sitting on one of the most extraordinary compounding stories in the history of the market. And then, 2009. The S&P 500 collapsed to 670 points. The consensus, from banks, from economists, from financial media, was that recovery would take a decade, maybe longer. Instead, $10,000 invested at that bottom grew to over $70,000 within 12 years. Same pattern, every single time. Fear drives prices below what the fundamentals justify. Capital moves from the people who panic to the people who prepare. Then the recovery comes, and the gap widens. Sandra didn't call the exact bottom. Nobody does. She just recognized the conditions that precede the transfer, and she got positioned before the window closed. Here's what most people get wrong about moments like this. They think the opportunity comes after the fear breaks, after the headlines turn positive, after it feels safe, but that's precisely when the opportunity has already passed. The best entry points in market history felt terrible when they happened. Anyone who bought Amazon in 2002 did it while the narrative was still collapse. Anyone who bought in 2009 did it while economists were still debating whether banks would survive. Comfort and opportunity run in opposite directions in a market cycle. The moment it feels safe to buy is almost always the moment the easy money is already gone. So the real question isn't whether you'd buy during a crash. Most people say they would. The real question is whether you'd recognize the structural signals before it becomes obvious, while there's still time to act. There are 3 things forming in the market right now that look almost identical to what formed before the biggest buying windows of the last 50 years. The first is market breadth expansion. When a market rally is driven by 5 or 6 large tech names, it's fragile. When it starts spreading, industrials strengthening, financials improving, energy showing renewed demand, that tells you something different. It means large institutional capital has quietly decided the long-term direction is shifting. Pension funds, sovereign wealth funds, major asset managers, they don't announce this. They accumulate slowly, over months, before the general public sees anything. That rotation is beginning to show up in the data now. Historically, 40 to 50% of companies outperform the S&P. For the last several years, it was 20 to 30%. Recently, that percentage widened to almost 60%. The second signal is liquidity repositioning. For the past 2 years, trillions of dollars have been sitting in cash, money market funds, and short-term bonds, earning decent yields while investors waited for clarity. A record almost $8 trillion sits in money market funds alone. As rate expectations shift, That capital has to go somewhere. Historically, when money starts moving from the sidelines back into equities at scale, it doesn't produce a short rally. It produces a structural move that lasts years. The third signal is volatility compression. When markets get unusually quiet, price swings narrow, movement slows, everything feels almost boring. Most investors read that as a lack of opportunity. But historically, extended periods of low volatility have been among the most reliable precursors to explosive directional moves. The market is coiling, and when compression releases, the move tends to be sharp and fast. None of these signals are guarantees. Nothing is. But together, they form the same setup that preceded the major wealth transfers of 1974, 1987, 2002, and 2009. Here's what separates the people who end up on the right side of the transfer from the people who end up on the wrong side. It's not intelligence, it's not access. It's timing relative to psychology. Group 1 waits for confirmation. They want the headlines to turn positive before they act. They want their instincts to feel comfortable. They want some signal from outside themselves that it's safe to move. And by the time all of that arrives, by the time the recovery is confirmed and the narrative has shifted, they're buying near the top of the new cycle, not the bottom of the last one. Group 2 understands the mechanism. They know the transfer happens during the uncertainty. They know that waiting for comfort means missing the move. So they prepare in advance. They identify what they want to own. They build the cash position that gives them flexibility. They decide exactly how they'll respond before the fear is loudest, so that when the moment arrives, they're not making emotional decisions. They're executing a plan they already made. Sandra wasn't different from her husband because she was braver. She was different because she had made her decision before the panic peaked. When the fear was at maximum, she didn't have to fight her instincts. She just had to follow a plan she'd already written. That's the entire game, made in advance or not made at all. Here's what that looks like practically right now. Quick pause. If you're looking for stock picks, Seeking Alpha has outperformed the S&P 500 by over 65% since 2022. There's a link for 10% off in the description. Back to the practicalities. First, know what you actually want to own. In environments like this, the distinction between quality and noise matters more than it does in a bull market. Companies with real earnings, manageable debt, and products people actually need tend to recover first and rise furthest. Build that list now, when you're calm, not when prices are moving and adrenaline is making decisions for you. For more on this, watch my video, Recession to Recovery, the sector rotation everyone misses. Second, protect or build your cash position, not as a long-term strategy, as ammunition. The people who captured the full 2009 recovery weren't fully invested when the bottom hit. They had dry powder. They had the ability to act when others could only watch. Third, if timing feels uncertain, use it to your advantage. Dollar cost averaging removes the pressure of finding the exact bottom, which nobody can do consistently, and keeps you participating in the move regardless of when it accelerates. Divide your available capital, deploy it gradually over 3 to 6 months. The people who built wealth in 2009 weren't the ones who perfectly timed the low. They were the ones who were positioned before the recovery became obvious. The pattern that formed before every major wealth transfer of the last century is visible again. The signals are in the data. The mechanism is documented. The historical record is consistent across 100 years and a dozen different crises. What isn't fixed is which side of the transfer you end up on. Sandra is retired now. Not because she was exceptional, because she looked at the same information everyone else had in 2009. And she understood what it meant before most people were willing to. That window exists right now. It won't stay open forever. If this changed how you're looking at what's forming in the market right now, subscribe. We publish fresh content several times a week to help you protect and grow your wealth. And watch this next, Recession to Recovery. The sector rotation everyone misses. It connects directly to what we just covered and will sharpen your thinking on where you may want to head. None of this is personal financial advice. This is education so you can build your own plan. In the description, you'll find links for 10% off Alpha Picks. You'll also see a link to my Wealth Builder's Blueprint. It's got a list of stock screeners, some paid, some free, that may help you compile your list of what you want to invest in. I also included a link to Zach's Confidential, a more economical alternative to alpha picks? Check them out. Thanks for watching. See you on the next one.